Hey everyone, thanks for clicking in with me. The US mortgage market is finally relaxing a little bit. Maybe it finally used some PTO and took a vacation or something. I don't know. Whatever it was, we're glad it did. Fixed mortgage rates are easing, lenders are adjusting, and the 10-year treasury yield, which helps set long-term borrowing costs, i.e. mortgage rates, is backing off its midsummer highs. Now, I'm a curious person. I'm going to venture to say that if you're watching this video, you're a curious person as well. I want to dig into what actually helped our friend, the US mortgage market, relax a little bit. We can discuss what to watch out for in September and October, and most importantly, let's figure out how you can take advantage of these improvements in rates, especially if you're buying or refinancing a home. Let's start with the 10-year treasury yield because, again, that's the heartbeat of mortgage pricing. Right now, the yield is sitting around 4.04%, down from earlier this summer when it was consistently bouncing above 4.2 to 4.3%. That drop certainly helped pull mortgage rates lower. When we zoom in a little closer on the chart, we can see the recent downward movement. What contributed to this movement? We'll look at three major factors. First off, inflation. The Consumer Price Index, or CPI, has shown some modest cooling. The headline inflation is easing, but core inflation, the stickier part, is still around 3.1%. That's better than it was last year, but not yet at the Fed's comfort zone. Second, the labor market. Job growth has slowed. We've seen weaker payroll numbers and rising unemployment claims. That softening is giving investors more confidence that the Fed will need to step in with rate cuts sooner rather than later. And third, market expectations. Bonds traders are already pricing in that shift. After the weaker jobs report, demand for treasuries surged, which pushed yields down and gave mortgage rates some more relief. Remember, we're discussing the 10-year treasury yield because of its close correlation to mortgage rates. As the 10-year goes down, mortgage rates go down, and vice versa. So, with those forces in play, where exactly are mortgage rates sitting right now? According to Freddie Mac, the average 30-year fixed mortgage is now around 6.35%. That's down from the mid 6.5% range we saw just weeks ago, and it's actually the lowest level in nearly a year. If you're looking for a shorter term, such as a 15-year fixed, those loans are in the 5.5 to 5.6% range. Government-backed loan options are seeing improvements as well. The average 30-year FHA rate is 5.99%, down from 6.2% last month. The 30-year VA rate is at 6%, improving from last month by 0.2%. South Dakota housing rates have also seen improvements, right around 0.5% better than the rate sheets from last month. Now, hearing rates are down is one thing. And don't get me wrong, it's great. But let's put this into real dollars so you can see what it means for a typical buyer or a homeowner. Let's take a $400,000 loan. At today's average rate, your monthly principal and interest payment would be about $2,492. If rates dip to around 6% even, which is very possible this fall, that drops to $2,398. That's a savings of $94 a month, or over $1,100 per year. If rates slide further down, please sit down and grab onto something. If rates go below 6%, 5.75, the payment falls to $2,342, saving $150 a month and $1,800 a year. These small percentage moves matter. Over time, they add up, and they can be the difference between stretching your budget or sleeping a little better at night. So, what happens from here? Certainly, nobody wants to hear that my crystal ball is broken. That bad joke has ran its course. But something we can forecast with a little bit of certainty are how things might play out as the market reacts to these major drivers. Always starting with inflation reports. The CPI and PCE data coming out in September and early October are critical. If they continue trending lower, bond yields should drift down, likely pushing mortgage rates closer to the 6 or 6.25% range. If inflation surprises higher, though, we could see rates snap back up. The Federal Reserve. The Fed meets in mid-September. Markets are leaning toward dovish signals. Basically, the Fed is hinting that cuts are coming. If they take a wait-and-see stance instead, the recent relief in mortgage rates could stall. Now the labor market. Weak job growth and rising jobless claims will support lower rates. Strong job numbers would do the opposite. Treasury supply and fiscal policy. Treasury auctions, government budget debates, even political risks around the Fed policy. These can all inject volatility. More supply or weaker demand for treasuries could push yields back up, regardless of what inflation is doing. All of this pans out by late October. Most experts are conservatively forecasting the 30-year fixed rates in the 6 to 6.25% range. Now, glass 100% full forecast. If inflation falls faster and jobs weaken even more, we could see rates push closer to 5.8 to 6%. Now, I don't want to get too carried away on hypotheticals. Certainly don't expect anything below 5.5% unless there's a sharp economic shock. As with anything, there are uncertainties. So what should you actually do as a buyer or a homeowner or someone waiting on the sidelines? If you're buying right now, I'll make it short, sweet, and simple. Lock in your rate sooner than later if you're closing within 45 or 30 days. If you're refinancing, run the break-even math. A drop of even 0.3 to 0.5% can make sense if you're staying put at least 2 years. If your current rate is 6.75% or higher, refinancing into the mid-sixes or lower can mean meaningful savings. If you're waiting, keep an eye on the inflation reports, the labor data, and Fed commentary. Get pre-qualified and keep your documents updated so you can move quickly when the right rate hits. In other words, don't just watch the headlines. Position yourself to act. I can just about guarantee you're not the only one watching these triggers. Improvements in rates are often accompanied by additional buyer competition. Here's the condensed, rapid-fire version. The 10-year Treasury yield is down to about 4.04%. 30-year mortgage rates have fallen to around the 6.35% range, the lowest we've seen in nearly a year. 15-year fixed and government-backed rates are also easing. September and October will be pivotal. If inflation keeps cooling and the Fed's leans dovish, we could see rates in the low 6% range. Bottom line, this isn't the time to wait forever. Market is opening a window of opportunity. Lock smart, shop smart, and focus on what fits your budget and long-term comfort level. Thanks for watching, and if you found this breakdown helpful, don't forget to subscribe, as I'll keep bringing more market updates and buyer strategy.